Good morning, everybody. Welcome to the Flow Show, Friday, the 8th of August. And I hope you're doing well. Got to the end of the week. First thing I want to say is for anyone who was on our webinar yesterday, thank you very much for coming. I'm going to ask you some questions. Well, one question I'm going to ask you. Don't have to answer now. I'll ask for answers nearer the end of the show. I want you guys and girls to pick one thing important that you learned from that webinar and let us know. Put it in the comments here. As I say, don't need to do it now. You can wait and I'll ask again later in the show. Or you can do it now if you want. But I want to know one thing that you learned from yesterday's webinar, because it's pointless us doing them if you're not going to learn anything from them. So tell me what you did learn. Morning, Kay. How's it going?
Good morning, Ryan. Good morning, everybody. Yeah, it's Friday, and I'm quite happy this Friday. It's been some week again. As we were musing about it in our chat room, seems like confusion is the 2025 transitory, right? There's a lot of confusion about a lot of stuff in this market right now. So let's hope we don't get more confusing headlines to end the week and have a bit of a more quieter one, let's say.
Yeah, I think confusing is best to describe the last 10 years, let alone the last 2 weeks or last week. Yeah, that's markets we're in at the moment. Right, let's get on with things. Finally, we seem to have a solution to one of the bits of confusion going on, and that's what's happening with Japanese tariffs, these 15% stacked, not stacked, or whatever. The US has said that they will fix the executive order and they will pay back whatever stacked tariffs have been paid later. So good old Japan, Mr. Akazawa, getting a refund on the 15% stacked, not stacked, whatever it was. So that hopefully a bit of confusion is sorted. We've had the BOJ summary of opinions for the July meeting. We had the minutes of the June meeting this week, which are a bit pointless. But the summary of opinions for the July meeting, well, pretty much just as pointless because they're all over the shop as usual. Some say we're getting ready to hike. Some others say there's caution, and they're all over the place. One member did say that rapid hikes could hurt the economy, but the wait and see stance may end by year end. So that was probably one of the most telling comments or important comments from those summary of opinions. As I say, the usual caution and all over the place. Jumping from one confusion to another. Bank of England, they cut rates 25 pips as expected. However, the votes were a complete shambles. They had to vote twice for the first time in the bank's history. They had to vote twice. The reason being the vote was split in a 4-4-1. So 4 people, well, the overall vote was 5-4 in the end to cut rates. So much tighter than pretty much everyone was expecting. It wasn't a 7-2, an 8-1 or anything like that, a 5-4. However, the first vote was a 4-4-1. That meant 4 people voted to keep rates on hold. 4 people wanted a 25 cut and 1 person wanted a 50 cut. The first thing with that is that the person you would have expected to vote for a 50 cut didn't. That's Dingra. She voted for 25. She's probably the biggest dove there. But another guy voted for a 50, Taylor. So he's now jumped into the arch dove spot. And he was forced to then, well, I wouldn't say forced, but he brought, in the second vote, he brought his 50 down to a 25, just so they could get a cut passed. So a lot of confusing shenanigans going on there. The Bank of England itself, in the statement, they kept their gradual and careful guidance on rates. No real change there. They're still following a gradual approach to cutting rates. Their forecasts showed inflation going up this year, or in 1 year's time, to 2.7% from 2.4%. Also an increase for 2 years, 2% versus 1.9%, and the same for 3 years. 2% versus 1.9 prior. GDP growth got revised up as well. They see a whopping 0.1% in Q2, which was actually down from the around 0.25% prior. But for 2025 as a whole, they now see 1.25% growth versus 1% previously. Absolute booming. 2026 was left unchanged at 1.25, same as 2027 at 1.5. So inflation slightly up, growth slightly up, but apparently, according to his nibs, rate cuts or rates are going to gradually come down. In their policy report, they said that the underlying GDP growth remains subdued, slack has emerged, but trade policy uncertainty is lower. Bailey said that the decision was finally balanced. Interest rates are still on a downward path, but any future rate cuts will need to be made gradually and carefully. He said there's good reasons not to expect a rise in headline inflation to persist. Although something I've picked up from all the squawkers there is that a lot of their comments have said that they weren't expecting what has happened in various aspects of the economy. So he still expects inflation to come down. He said we should expect a gradual normalisation of pay growth to feed through to lower services price inflation. But we must be very careful that higher food and energy prices do not lead to any second-round effects on wage or price setting. And he said inflation growth is weak and risks to inflation is shifted to the upside. He says we stand ready to adjust our house if we see shifts in the balance of inflation risks. And then he did a bit of a rug brush in terms of what's happening with UK yields, which are actually 10-year yields, and probably the rest aren't far away. One of the highest in all the major developed economies. I think we're just under India, whose 10-year yields running around 6.5%. And we're just under that, well, something like 7th on the list in highest 10-year yields. But he brushed that all under the carpet, saying, I do not think higher UK borrowing costs reflect concern about the BOE focus or government borrowing. There is no particular UK story in the rise of bond yields. Absolute horseshit. He said pay growth is coming lower than we expected in May. Again, the missing expectations. He says, when I speak to businesses, I sense they are delaying investment decisions. Bit of a strange comment, because if you've actually spoken to businesses, you don't need to sense anything. They've told you. So either they have told him or they haven't told him. Who knows? BOE's Lombardelli said food inflation is higher than the BOE expected. There we go again, missing expectations, and that food prices are to carry on rising. So long story short, they cut. It wasn't a dovish cut, not a hawkish cut either. So going to call it me old undovish. They're still going to stay in a slow and steady approach, not entering a new cut phase at all. Hence why we've seen the pound marked higher since then. So you know where we are. They're still in the same boat, slow and steady. Kay, any thoughts on the clown show or anything else?
Yeah, well, less dovish than expected. Market going in short sterling, I guess, and needing to buy some back, and yeah, yeah. So yesterday I thought they would be more dovish than this, and well, yeah, we've got that undovish. If you look at the expectations, could actually be interpreted as a near hawkish one, because they did revise or try to revise growth a bit higher together with inflation expectations. So if you just read the letter, it's actually yeah, the opposite of what I expected anyway. And that's about it, really. Let the data do the talking. I did not hear much more from Bailey or the others about everything. A lot of talk, but nothing really new compared to what they already said in the statement. Yeah, the surprise, and there I'm also at that surprise that I thought Dingra would actually, together with Taylor, vote for a 50, and she continues to surprise us all. When there's no need to cut, she wants a 50 BP cut, and when there is all good reasons to continue to cut, she goes on to the defensive. So yeah, it is clearly less dovish than what everybody, me included, were expecting.
Yeah, absolutely. Can I just check? Can you see my screen?
Yeah, I
Okay.
see this. I see the web page, right?
Yeah, yeah. So I don't
Yeah,
know
yeah.
what's going on with yours, Galaxy. Unless you think that
That
that's
Galaxy
the
means
screen.
maybe the data or the charts also. But no, we. I hope Galaxy you can see a screen, the main web page, for example, analytics web page.
Yeah.
Well,
Right. Well, I'm going to. Yeah.
there we go.
Okay. So that's the screen. Cool. Right. So now I'll move on to the data stuff because there wasn't a lot out anyway. But we'll look at yesterday's stuff. We got a bit out of the US. Initial jobless claims still all tickety boo. There was a minor tick up in the continued claims to 1.974, but that's been sitting in the 1.9s for a while. Headline number 226, nothing to note there. That 4-week average staying steady. We did have some Q2 data. Unit labour costs coming in as expected, 1.6% down from the quite hot 6.9%. Productivity, that increased 2.4% better than expected of the 1.9%. Inventory data, not really telling us a whole lot. Inventory's up 0.1%, slight miss on expectations, but again on last month. Sales, that returned to growth at 0.3% from the prior minus 0.4%. As I said, not really a lot to take from that. 30-year bond auction.
Week.
Yeah, another wobbler.
Yeah, week. I mean, actually, that went through a full 2 BPs. Now, has to be said, those amounts in the very long term are not the same as in the shorter end, as we know from the U.S. Treasury. But nevertheless, it was a weak one. That is just telling us the market is still not convinced about the fiscal side, bond auctions. What's going to happen? We still need to be making some calculations between receivables and payables on the tariffs and tax cuts and stuff. So yeah, that is not a market, or that is not people going to the auction and saying like, yeah, we are going to bid for that. No, that was a very weak, or pretty weak actually, auction. Yeah.
Yeah, thanks, mate. It's definitely something we're probably going to need to keep an eye on as we move forward. Mexico, they cut rates 25 as expected. They're now at 7.75%. That was a little bit of a split vote as well, 3-1 in favour. Heath voted to hold the rate. Statement, no real change in any news there. They're going to continue to monitor things and, if need be, continue to cut. But the votes may indicate things might be flattening out a bit. Fed's Bostic says there's a ton of economic scenarios that could play out, and it's hard to assign probabilities. That's his technical term for saying he hasn't got a clue what's going on. Says the July jobs caused a shift in thinking about how the Fed is doing on its employment mandate. Says one cut for this year remains appropriate, but there is a lot of data coming before the September meeting. Treasury Secretary Bessent was out saying trade deals are largely done, except if you're India, China, Swiss, Europe, and everyone else who hasn't got deals done yet. Even Japan still haven't got paper signed, sealed, and delivered. But apparently they're largely done. The Swiss government said that the Federal Council is to continue negotiations with the US. Have those tariffs gone on yet, Kay? Is it today? No, it was yesterday, wasn't it?
The what the yesterday was the supposed to be the deadline, no?
Yeah, that's what
So
I
it's
thought.
probably going to have to start to be paid from today. That's what I would suppose. But we never know.
Yeah, exactly.
We never know whether the customs already have the real numbers, or there's still enough confusion for
Yeah,
them to not be able to apply some of the tariffs, as we have seen with Japan. They
exactly.
actually applied more than they should have. Eh?
Yeah, exactly. China got another 90 days added on to their trade tariff talks deadline thing. So you can see where the focus is
Nine,
on who they want to squeeze.
90 going on 360.
Yeah, exactly. Another year. And we've got gold tariffs now, which is impactful for the Swiss because, well, again, more confusion. We don't know exactly what's going on, but there was a headline, or there was news that Trump is going to place tariffs on 1 kilo gold bars. Why this is important for the Swiss is because they take a lot of gold and they break it down from bigger ingots into smaller ingots and then export it to whoever has ordered it and whatever. But now there's tariffs going on that, but we don't know if the tariffs, what the tariffs. I don't know what's going on. Kay, you answer that one. is there
Uh,
tariffs or is there not tariffs?
they no, they are not tariffs, right? They are duties.
Oh, geez, sorry.
And I mean, no, I mean, what do you want me to say? I mean, tariffs now have, we can use 10 words, 10 different words. It's just a tax, right? So yes, that gold is transformed and transits through Switzerland. So quick calculations made by the specialists saying that that could impact another 24 billion exports from Switzerland to the US. So yeah, it's. I was like thinking about this morning. Is has Trump got his S wrong in BRICS, and he thinks it's Switzerland and not South Africa? So that is part of the BRICS. It and I still find it a bit strange that they can't find a better agreement with Switzerland. But yeah, I thought that Swiss would actually remain on the defensive on the back of it, because it's another stab in the relationship between Switzerland and the US. And there is, as you, as you say, here we are again, a lot of confusion about what the gold market has to do with it, especially if you look at the CFD and the spot, etc. There's a big spread now, physical over cash and spot, and I think that's where the real thing lies. I was actually thinking, but it may have been like a first reaction. I said, well, if you make gold more expensive to have, let's say if in this case you are a US buyer, is it not negative for gold, because you maybe not don't want to buy the increased price, but then it's just actually the spread going up. And if you look at gold, the rates are it's still very big, around 3,400, which was a bit surprising on the reaction. Actually, if you look at when it happened, when it came out, the reaction was exactly of confusion. Gold ramped $10 higher and then lost $20, $25 straight away, and now we are back at 3,400. So I think that the gold market that we trade, or the traders trade, it's a bit confusing. I think, and then moving on to maybe another subject, I think there's enough still uncertainty or reluctance to believe that something is going to happen between Ukraine and Russia on the one hand, and on the other hand, that Miran nomination is that's probably what's holding up the gold market. But yeah, specifically about this thing about the customs department, I'm not sure what to read in it right for the gold price. I think it's rather another tax on Switzerland, basically.
Yeah. I mean, I can see cases for why gold might go up and down. I mean, as you put that
Exactly.
note from BNP, those 1 kilo ingots, they're part of the delivery mechanism if you're trading on the COMEX exchange. So if you buy gold there, then you're getting the Swiss to cut up your gold into 1 kilo ingots to then deliver against your contracts. So there could be people who are shipping in that gold, buying that gold quicker to beat any tariffs or duties that may come in on it. But then on the flip side, if it's going to cost you more, then you might want to sell out your contracts anyway. So it's all up in the air. And then you got the risk thing going on as well. You think gold might be coming lower because we potentially going to get some sort of deal, some sort of thing happening with Ukraine, Russia, which is good for risk, but we're not seeing that. So when you don't know what's going on with the fundamentals, just trade the levels. That's all we can say about that one. Right, who's next? Right, we'll get on to the Fed stuff, because Bloomberg dropped a line that Waller has emerged as a favourite for the Fed chair, and this is amongst the Trump team, his cabinet or team or whatever advisors that Waller's come through. Apparently because of his willingness basically to cut rates, i.e. kiss ass and do what Trump wants him to do. Interestingly, we got the White House's chair of the Council of Economic Advisors, Stephen Meehan, saying that Fed's Waller has built up an impressive track record and hasn't succumbed to tariff derangement syndrome. He spoke about that before he got put forward and nominated to the Fed board. So an interesting note there that he was speaking about Waller before he got put forward. Now, he's only been put forward until the end of the year. He's just basically filling Kugler's seat, I think, until the end of the year. The end of January next year. So it is only a short-term slot, while Trump then can look at who else he wants to put in. It came as a bit of a surprise, this one, Kay. The name pretty much out the blue. Obviously, everyone's looked back at his old history and the fact that one of his big things was about seeing a weaker dollar. But you can never, it's that old chestnut, people say things when they're not in the hot seat, but can say something different when they are in the hot seat. Is him going in going to make a difference to anything?
He's been always very critical about what the Fed's been doing. He's also one of the architects of Trump's tariff game. Yeah. Well, there is this question which you just raised. Once you're in the seat, and we've seen that with so many central bankers in the past. Before they're in the seat, after when they left again, always very critical and having very outspoken ideas. But when they are in the seat, being like the nice little nodding dogs. I think with Miran it may be slightly different because he is, how should I say, buoyed by his Trump support, right? And all the hawks in Trump's administration. So he's probably going to be. Hawks, I mean, on the hardliners, okay, not hawks for interest rates. Don't get me wrong here. But yeah, I guess he's going to make quite a bit of noise, no matter how we turn it. He's also since he's only going to be there until January. If he would have been there for 3, 4, 5 years, I would say okay, he's probably going to get a little milder. But he's only there for 4 or 5 months, so why not make a lot of noise? The guy is not really there to be Powell at Powell, at least. He's not there to be the team player, right? He's there to stir the pot, I think, and so. Yeah, I think we may see a bit of noise coming from it. Is I don't know if he's straight away going to be on the voting side, but if he is, he's probably going to be voting for Gus straight away.
Yeah, that was my next point. If he's replacing Kugler, then I think he's going to be in the voting spot.
I don't know. Well, I don't know. Yeah, I don't know the rules, Ryan.
Neither do
I
I.
really don't know. It could be if you replace it somebody who has been who was a voter. I don't know the rules, but yeah, you may obviously be completely right about that one.
I think that's what we should possibly expect. So we
Yeah,
should. That means we should be expecting at least three dissents
yeah,
at the
absolutely.
next meeting. Well, I say
Well, no,
dissents.
three
That's if they
dissents
don't,
unless they cut. I
unless
mean,
they cut, of course. Yeah,
but he could be he could be the one voting for the 50, yeah?
yeah. But yeah, but then we could get September. They're cutting anyway, and then it's he's not got any shouting to do because they've cut, unless he wants a 75 pip cut or a 50 or something.
Yeah, that's the risk there. But then, you know, there is also the fact that he's there, but the market will have done its homework on and already probably has done its homework. We have seen and that when we talk about like market moves, etc. When at the start there was so much criticism on Powell, we saw like very big moves in markets lasting for several days. Now we had this sorry, this nomination after the London close, we had give and take 12 hours of a yo-yo and or even dollar selling, and the market quiets down because the market by now has done its homework and we know what to expect. So any impact from him, unless he really starts to uh, um, break down doors and walls, etc., really going extremely hard, that will have an impact. But I think more than probably having the impact of a stick behind the door for the dollar, perhaps. It's the market knows about it, and then that means the effect is probably going to be less than um, if Trump really, when he was wielding that piece of paper, which was absolutely not Powell's resignation, but he was showing it to those Republicans, and that impact was a lot bigger than this one because the market is starting to get used to it.
Yeah, yeah, very much. So it's a known unknown.
Yeah.
Okay, so we don't know what he's going to do, but we know likely what he's going to do. So it's not going to be a shock if he does exactly that. Right, onto the Ukraine stuff. Trump said that the Ukraine-Russia ceasefire is up to Putin. Says Putin does not need to meet Zelensky before meeting him. So we've still got this deadline. There's probably going to be something coming later today in terms of extra sanctions on Russia. Although Trump's deadline was 9th of August, I believe, which is tomorrow, but he'll probably go ahead and announce something today. I think this could be another mover for risk. He said he's going to slap on extra sanctions if there's no movement by the 9th. If he doesn't, if he gives those a little bit of a can kick, a little bit of a delay, or says that things are progressing, that could see risk taking a little bit of a bounce. Otherwise, if sanctions go on, then we are perhaps further than where we'd want to be in terms of seeing something happening positively out of that situation. Elsewhere, Trump's team is now looking to get rid of other officials. This time, the second in command at the IEA, International Energy Agency, because the IEA has discouraged investment in fossil fuels by publishing analysis that show near-term peaks in global demand for oil and gas. So they've had a continued bum fight with the IEA over what they've been putting out, and now they may be pushing to have a little change around in there as well. Right, anything else for anything else, Kay?
No, I think we covered most. It's going to we're back to confusion. Is it not going to confuse the market? Then whenever he fires heads of these statisticians there, whatever. What is the market going to believe when people put out reports now, especially if it's going to be massaged in the direction of you're talking about IEA now. There's the Intel stuff. There's whoever the lady from the BLS. I mean, how worthy are all the reports going to be? That's another one for markets to get a bit confused about, I reckon, in the months coming.
Yeah, but this is a point I raised a couple of days ago. It is all political anyway because it's presidents who nominate or
Hmm.
who vote in
Yeah,
heads of the
yeah,
BLS. It was Biden who put this woman in play. It's no different to any other government who
yeah.
change around staff when a new party takes over.
No, but it's
So
done in a different way.
yeah, yeah. Oh, it's done quite. I mean, no one fussed that Biden was putting in someone at the BLS. No one even knew about it.
Mm,
But Trump does it, and it's big news. I'm just saying, yes,
yeah.
Trump is obviously a disruptor, and you can't get around that. But the mechanics is he's not doing what
Yeah,
any other one hasn't done.
I agree, but it does it, but it does it in a different way, right?
Yeah,
No, the thing is
with a
also,
bulldozer.
and I'm talking about confusion because it's like really the word of the word of this time. But as we already also said many times on our show here, and I've been repeating that earlier as well in the week, at one stage, the only thing we can do is take the face value of the data and let a lot of people say and think that they've been manipulated or whatever, but data will drop and the market will react on the face value of the data. So brings we should, us at least, we should try to keep things as simple as possible because overthinking everything is not going to help anyone's trading in any way.
Yeah, very much so. Right, well, just quickly before we get stuck into the prices, there have been a couple of thoughts from you guys. Astra FX saying his biggest takeaway was entering trades with the primary thought being risk and not the potential profit. So he's going to try and work at that, or she's going to try and work at that and look at the trade upside down. Think about risk first, profit second. So that's a good thing you've taken from there. Laura says discipline emotions. If you are wrong, get out. Yeah, there's two sides to that. We all talk about if you're wrong, get out. But if you've got a plan in place in the first place, you know where you're going to get out if you're wrong. So if you're trading without a stop, then that's slightly different because then you've got to have that get out where you're wrong. But you should be trading with a stop, be it a disaster stop or a fuller stop. So yeah, if you've got your I'm wrong, get out, you should already have that in place before you start trading. Also got who we got Gavin talking about the demo thing. Yeah, I'm in the same boat as Kay, slightly different. Yes, the main thought is when you start a new platform, get on a demo, learn how the platform works, what buttons to press, how your orders work, how your stops work, just the mechanics of it rather than anything else. And then obviously you're going to progress onto a proper account. But my view on demo accounts is I don't mind jumping on a demo account if I've been on a bit of a losing streak. If I lose 4 or 5 trades on the trot, I'm going to pause my trading because something's not working, and then sort of you get back on the bike. You go and do your practice. I might hop onto a demo account and just do a few things just to see is it me that's wrong or is the market changed, just to iron out. But I'm not going to stay on there for months. It's literally just maybe a few trades or a week, just until I'm back in the groove. So that's my use of demo trades. I'm not scared to use them. But Kay, you were talking about, yeah, it's different
Yeah,
if
I
people are
think
sitting on a demo account alongside a trading account.
I think it's more case of reduce your amounts and just go in tinies just to get back into it, just to review your way of approaching the market, perhaps make changes because plans are plans, a strategy is a strategy. We've been talking very often as well on these shows like okay, well there is some things where I've been long silver for years, for instance, but the thing is in today's markets, if you look at the majors, whatever, I mean it's very hard to defend a position for longer than a few days, because unless you're extremely deep in the money, of course, but for a few days, because you have somebody, and a few of them, who can bring out headlines, who throw a market completely upside down, and therefore it is the. But so I mean, plans change, strategies change. The discipline should never don't change. So if you have a problem with your plans and your strategy, you can change it, keep your discipline, but just reduce your amounts. Because yesterday we could have gone on, and Ryan was saying exactly the same. We could have gone on for another 3 hours, because there's so much to cover and each and every one has like this different approach. By the way, if you want to talk to us in a bit more private, we also have still our coaching going on, if you want to talk to any one of us. But I'd rather reduce my amounts, because I really think that if you go into a demo account, it's very bad for the focus and for the feel of responsibility of your trading as well. I mean, it's so much more easy to gamble when you're on a demo account than to really think about what you are in and feel the responsibility. It's a different thing to feel the responsibility and to start to be afraid of losing. That's completely different, right? But you have to feel the responsibility, in my opinion, to when you're trading. But anyway, as I said, we can always pick that one up. Actually, talk a bit longer about it one day. There's no problem.
Yeah, absolutely. And Mark, in our chat room, very nutty, had a good point yesterday. He basically said one of the things he picked up is that we can all have different trading scenarios, but the principle of how we trade is all the same. We can all have different views on markets, and I said that in the webinar as well. So did Nick. You know, we can all be trading the same asset differently, but our approach is all the same. Our approach is from a risk management perspective first. What am I going to lose? Prepare for the loss, plan my trade. All that mechanics is the same. Whether I think something's going up, Blake thinks it's going down, Kay thinks it's going sideways, whatever. How we approach the trade is exactly the same. Angela, she says main takeaway was the confirmation that successful traders are self-aware, risk averse, take responsibility, and have learned from their past experience, and are patient and disciplined. Yeah, risk management and anything discipline. Okay, it's one of the hardest things for traders to learn and get right, but it's one of the easiest things to employ once you get the hang of it. Okay, once you get the hang of it, it's a bit like seeing the Matrix. You think, why wasn't I doing this months, years before? And you've just got to get to that Matrix point where you see clarity and you say, yeah, this is how it should be done, and then it becomes automatic. It becomes as automatic as breathing. When you look at a trade, you don't think, oh, how do I manage my risk? You do it automatically. You don't have to think about it anymore, and that's what you need to get yourself to, because it gives you a whole calmer state of mind from that point onwards.
Who are you in the Matrix, Ryan? You can't be Keanu Reeves.
Red pill or blue pill? I had the green one. But yeah, well, you know, it's like, I mean, you're in the same boat. It's like any job you do.
I mean,
you know, you
thing,
don't know something, you have to learn it. But once you've learned it, then it's second nature.
Yeah, and you know what, guys, give yourself the time to learn it. And if you give yourself the time to learn it, and if you get that experience, and Angela said exactly the right words, etc., it in the end it becomes an automatism, and you're going to more spend more time on planning, waiting for trades, the right setups, etc. But your discipline and your risk management is going to become an automatism. Okay, you know how much you want to risk. Whenever it is, I don't know. I mean, and everybody is different, because you say like, okay, you can be strict. Like I only want to risk 0.5%. I only want to risk 1%. I want to risk $500. I want to risk $1,000. But some people who have been in markets for longer, maybe, or who have a different approach, like doing intraday trading. They can risk much less, but if you have a longer term position, you can actually risk 4, 5, 6, 7%. Who knows? I mean, that is not fixed. That everyone needs to sort out for him and herself. The thing is, you need to give yourself the time to learn, and positive self talk is important, Angela, but I would say that that is coming automatically as well. I mean, we all take that, that is with the acceptance of having bad traits in your in your period as a trader, or your I don't know, some people that make it a career, other ones do it for other people. I mean, I'm a bit like in between the whole thing. But so for me, managing the risk is extremely important, because it's not only for my own, but it is, yes. But you learn also to remain positive and feet on the ground, and just not let the market drag you, but you get a grip of it, and sometimes that comes with a little bit of hard words towards oneself.
Yeah. And Michael's put an interesting point. He says managing his risk is easy. He needs help managing a trade in process or in progress. Yeah, and but that's good. That's great, Michael, because you've already got over your risk step. You've learned the risk step. Now you need to focus on the next thing. Maybe when you started trading, you didn't know the risk step and you had to learn and you had to get it. Now you've got it. Now you move on to the next part of your journey. Help managing the trade when you're in it. What do you do? Stop yourself getting fearful if you're in profit and it's not hitting your target, but you take profit anyway because you're scared you want to give it back. That's the next stage of it. I mean, we could do a whole day's worth of webinar on that just alone. But that's progress, Michael, and that's what you've got to go through. Your first step is risk. Then you take the next step, to trying to make money and pushing trades and not being scared of being in a bit of profit and taking it back and getting out too early. So that's it's good because you're over stage one, you're into stage two. Get over stage two, then you're into stage three, and you're doing what all us are doing, losing your hair and shouting about Trump every day. You don't, unless you're extremely blessed, you don't learn to drive a car in a Ferrari. You just learn in any old car. It's not about the car, it's about learning to drive. After you've learned to drive, then you worry about what car you want to drive. And that's the same with trading. Learn the mechanics, learn what the boring stuff, learn how things work, and then progress on to how you're going to make money out of it. Right. Anybody else? Just throw your stuff in there as always, and we'll if we've got time, we'll grab a couple more. Kay, I'm just going to pass it over to you for a couple of charts straight away. I'll keep an eye on the comments.
Okay, mate. What are we doing? What are we doing? What did Michael ask for? Euro dollar, Aussie dollar. Yeah, let's just stick to the whatever the majors are doing in here, because looking at the time, we've been talking a lot, and it's sometimes extremely interesting to talk about a couple of other things than just purely prices, because what we see in the prices is a very rangy market right now. That's what I was kind of thinking about yesterday. Obviously, those Miran lines, they sent euro dollar back up from where the dollar was trying to correct, and I thought we would be like perhaps going into this kind of scenario, 115.5, 117-ish. It's still possible because we are like somewhere in the middle of the range. There's a few levels in between. If you look at where we stopped again today, just around there in those 70s, but basically, I mean, for as long as we are in between 117, give and take 5-10 pips, and then this 116.10, 116 the figure, it's going to be very tight if we get through on a day like today, unless we get really headlines that take it apart, and then I'm especially thinking about political or geopolitical headlines, because we don't have any data barring the we do have the Canadian jobs report, by the way, today. It's I guess it's going to remain a bit rangy, knowing that Miran is there. Maybe the slight, but I'm not going to overstate these slight bias of selling dollar rallies, perhaps, but I'm not even thinking too much about that right now. And so I think we are just going to bounce up and down for the rest of the day here. Let's have a quick look at that dollar cat. And I know I'm still looking at a completely different picture than everybody else here. We had this big move up into the 138s, but to me we are back below this little crossroad here that I noted a while ago. I should perhaps refresh my chart a little bit on dollar cat because I haven't really done much on the Canadian dollar of late. But still, I'm not overly convinced that we are really going to continue to push higher here. I rather think that we are, and I think did you note that level too, Ryan? Just in the low 137s here, around 137.15, 20-ish.
Yeah, 2035 is my zone.
Yeah, okay. Yeah, okay. Yeah, I've got your 30 here as well. So we are right on there. And so on the Canadian jobs report, always watch a couple of things. If the employment change doesn't tell us much, the balance between full and part-timers may give a bit of give a bit of a move as well. Sorry. But I think any move back up now around that 137.80, give and take 5-10 pips, we may run into trouble again if we get up there, unless we get a stinker of a report, obviously, right? If in turn we get a very good report and dollar elsewhere is not picking up too much, there is a chance here to get back to a bit lower levels, I would say. If you take this, I think there's the 136.90, but then here we are going to come, but for that it needs a really, really, really good report, okay? Low 136s is going to be very important. Anywhere from 136.40 down to 136, the figure, that's going to be, in my opinion, a quite important zone now for the dollar cat. Again, I'm not sure we're even going to get that much, but being just above or below this little zone here, 2030, could be enough on the close of day to tell us where we are going to go, perhaps into next month as well. I think the close of day above or below this 137 2030 is going to be important enough. I think you asked about the Aussie, no? Was it Mike or so? Still banging our head against that 65 35 50. That's really still the magic zone for any deeper move, okay? For as long as it doesn't go above, I think we should not get overly excited. There is, as Ryan already mentioned, I think there is some really decent, and I think it's like common knowledge by now, very decent expiry around 65 the figure right now, today, sorry. So if we get anywhere closer, it may magnet into 3 p.m. London time, that is. So transpose that to anywhere you are in the world to get your time there. But if we are anywhere close there, we may see a move afterwards. Okay, I am a little long. Let some go this morning again when on the approach of that zone. But I'm still looking at the Aussie, globally speaking, a little more positive. Now, is it Aussie dollar I want to really have, or throw it into a cross one day or another? Remains to be seen. But in the global picture, I'm okay with the Aussie right now. Let's not forget that we have RBA next week, but we'll talk about that. What else did people ask? I'm not going to cover much more because I really think, I don't know what you think, Ryan, but we are trying to form some of those ranges, no? And I don't know what you think about this idea about ranging. We went through on the cable here, and because just the report I mean, the Bank of England was less dovish than expected. Just note, I don't put the line here, but this is an interesting. I think I have it on the longer term actually also. But look at where we stopped right here around 134.5. That's a bit of a zone here. Okay, so one try, second try, banging our head against it for the time being. It is not far away from it, so any move back through it should take us to 135. To lose steam, we need to get back below 134.15. So 134.15 is your first level, 134.5, 135 above. And then obviously, if the dollar would see some strength from somewhere, we are going to be talking again about the 133.65.75, no doubt. And with that, Ryan, I give it back over to you, mate.
Thank you very much.
And yes, tell me about what your thoughts are on a bit more range forming.
Yeah, I think we've got that stuff where where prices tend to go a bit to sleep in between any big news or data points. Yeah, cable may be set up range. I've had a little nibble myself there, that 134.50. I'm not that confident in it. Let me just share my screen quickly, and then I can give you my eyeballs on it. Let's get into cable. Let's come in, and Ali should do it. Yeah, I've got a line up here, 45.50. That's been a bit of an old level going way back. Yeah, this dip was fairly shallow. We had the first test; it was fairly shallow. We've come back. I haven't got actually any conviction. I've had a little snip out of the trade already for 10 pips, but it's come back pretty quickly. I wouldn't be surprised if we do shift higher. I've got this 50 retracement here at 65, so keep an eye on that one as well. But yeah, it's this trend has been going on for all month. Is it going to suddenly stop here? Who knows? But this might be a bit of a congestion zone that we might find a bit of a struggle at. So keep an eye on that one. And last one, euro sterling. We also got a bit of option activity there as well around this 60-70 area. We've got I think it's just under 1.8 billion going off there, which not huge in monetary terms, but for this pair it's quite a big one. So again, just keep an eye on that. And for that Aussie dollar expiry as well, what you want to be looking at for this at this 65 level, okay, is what all the other dollar pairs are doing going into that expiry. If we're seeing cable shooting up to 135, if euro dollar's shooting up to 117, Kiwi dollar's ramping as well, and this isn't moving, okay, then that's likely going to look like a bit of option effect. Of course, if this is going up to near 66, then the options are going to have absolutely zero effect on the market and what it's doing. But that's the sort of thing I look for. Anomalies in prices, price moves into those expiries when there's big expiries going on. But all that information you can find in our platform. Right, that's that. Good week, everybody. Thank you very much. Love the webinar yesterday. Thank you for all your thoughts today as well. A bit of a follow-up. Of course, if you're in our chat room, you can ask these sort of questions every single day, okay? The only stupid question is the one that's not asked, okay? No one's going to turn you away from asking a question or hearing the shows. Thank you for coming and supporting us here. Thank you, Kate, as always, for your stuff this week. Have a great weekend, everybody, and we'll see you next week.